Thank you for joining us for Hindustan Zinc's third quarter fiscal 2019 results call. For our call today, we have with us Mr. Sunil Duggal, CEO, and Mr. Amitabh Gupta, CFO. Mr. Duggal will present an update on business performance, while Mr. Gupta will present financial performance, after which we'll be happy to take your questions. Over to you, Mr. Duggal.
Thank you, Preeti, and a warm welcome to all of you. I am delighted by the all-round improvement in performance of our underground mines. Rampura Gucha has accelerated its run rate from 2 million ton a year ago to 3.5 million ton per annum now. Sindeswar Khurd has been consistently delivering over 5 million ton run rate with improving silver production. We have achieved record decline development in SK, which will help in opening new blocks to deliver high level of production going forward. With substantial improvement in infrastructure, Zawar is now delivering at a run rate of 3.5 million ton. At RD mine, we are upgrading the existing shaft and carrying out major infrastructure enhancements. Ore production run rate is already at 1.2 million ton. We have conducted public hearing at Rajpura Dariba for expanding mine and mill capacity to 2 and 2.5 million ton respectively. Going forward, with the scheduled commissioning of shafts, mills, paste fill plants, smelter debottlenecking and fumer, you can expect higher overall metal and silver production. Our current performance and ongoing project ramp-up gives us confidence to reach design MIC production capacity of 1.2 million ton in FY 2020. And now I'll give you the update on the zinc market. Fundamental of zinc market continued to be robust. Exchange stocks, as you know, are at 4 days of global consumption, which is the lowest since 2007. Consumption has increased by 1.5 million ton in the last 6 years to over 14 million tons now, and expected to accelerate going forward. In China, steel production increased despite the ongoing US-China trade standoffs supporting global zinc consumption. On the mine side, supply is stagnant at about 13 million tons since 2012. Market has witnessed a history of new projects being commissioned much lower than anticipated. We firmly believe that zinc metal has very strong fundamentals, and I really wonder why zinc prices should not bounce back to early 2018 levels. Now, I will give you the update on our operating performance. MIC production of 247 KT during Q3 was marked by higher ore production and improvement in ore grades. Sequentially, MIC was up 6% primarily due to ramp-up of RD, Zawar mine. MIC was up 3% from a year ago, driven by 38% increase in underground ore production, which more than offset closure of open cast operations. Year to date, MIC from underground mine was 691 KT on account of higher ore production and grades, even as the closure of open cast operation caused YTD total MIC production to remain flat. Integrated metal production was 242 KT, up 14% sequentially and down marginally from a year ago. Integrated zinc metal was 188, up 16% sequentially on account of higher mine output and improved MIC availability, while it was down 6% YOY due to higher lead ratio in ore. Integrated lead production jumped 10% sequentially and 18% YOY to a record of 54 KT on account of higher mine output as well as retrofitting of pyrometallurgical smelter to produce more lead metal, considering better availability of lead MIC. Integrated silver production was also a record 178 ton, up 3% sequentially and 34% YOY on account of higher lead production and better silver grades. Integrated metal production for the year to date was 667 KT, down 5% YOY. Zinc production was 522 KT, was lower by 11% YOY due to higher lead ratio in ore. Integrated lead and silver production were at 145 KT and 488 tons, higher by 23% and 26% YOY, respectively, driven by higher lead MIC and better silver grades. Going into the final quarters of the year, we are confident of delivering our guidance of slightly higher MIC than last year. Metal production will keep pace with MIC production, though it may be lower than last year. Silver production will be in the range of 650 to 700 tons as guided earlier. Now an update on the progress of our expansion project during the year. Rampura Gucha underground mine achieved a record total development of 6.9 km during the quarter. The shaft is presently being used to hoist waste through mid-shaft loading system that we commissioned last quarter, as you know, which helped us in increasing production from the mine. The full shaft commissioning will happen in Q2 FY2020 and will be synchronized with the completion of crusher and conveyor system underground. A ramp-up of the mine will be as planned, as we will continue to produce from decline and mid-shaft loading system. Sindeswar mine achieved highest ever total mine development at 5.9 km during the quarter. The new 1.5 MTPA mill was successfully commissioned and produced its first concentrate during the quarter. The production shaft work is reaching completion now, and shaft commissioning is expected in the current quarter, which is Q4 FY19. At Zawar, achieved total mine development of 7.1 km, which is 9% higher from a year ago. Completion of the new 2 MTPA mill is on track and expected to commission in the current quarter. At Rajpura Dariba mine, total mine development jumped by 42% to 1.85 km. During the quarter, we placed order for a new 1.5 MTPA capacity mill with projected commissioning in 14 months. The Fume project at Chanderia is expected to complete in the current quarter. As part of our sustainability initiative, we added 22 megawatt solar power over waste dumps in Rampura Gucha, which takes our total solar capacity to 38 megawatt and total renewable capacity to 350 megawatt. This is in direction also to meet our obligation. We have also commissioned 25 MLD sewage treatment project in Udaipur in taking the total capacity to 45 MLD, which will treat over half of the Udaipur city sewage and help improve availability at Dariba. Before I hand over the call to Mr. Amitabh Gupta to take you through the financials in detail, I would like to make a couple of announcements. Amitabh has been playing a key strategic role as CFO and will now take on an enhanced strategic role within AZL. We have inducted senior leaders into the company. Kavita Singh joins us from Merck's Southeast Asia as Chief People Officer, Arun Vijay from Reliance Jamnagar as Director Projects, and Swayam Saurabh from Philips Singapore as Head of Finance and Acting CFO. Swayam is a qualified chartered accountant with over 18 years of rich experience with organizations such as L&T, Asian Paints, and Philips. His last stint was with Philips in Singapore, where he was heading finance for B2C business for Asia Pacific region. He has joined us on call today. Swayam, would you like to say a few words on this occasion?
Thank you, Mr. Duggal, for your kind introduction, and good evening, all of you. I'm thrilled to be part of Hindustan Zinc and Vedanta Group. We have a great team at Hindustan Zinc, and I'm excited to build upon the team as we continue our growth journey with a very strong focus on governance. I will continue to work on our initiatives around cost optimization and accelerate our efforts on digitization. I would look forward to interacting with all of you in future. Thank you. Now, I will request Mr. Gupta to present financial performance.
Thank you, Swayam, and good afternoon to all. Revenue from operations during the quarter was rupees 5540 crore, an increase of 16% sequentially, primarily due to higher metal volume, rupee depreciation, higher zinc price, and domestic premiums, and partly offset by lower lead prices. Q3 revenue was down 6% from a year ago on account of lower metal prices, partly offset by rupee depreciation. For the year to date, revenues were unchanged as higher lead and silver volume and rupee depreciation were offset by lower metal prices and lower zinc volume. The zinc cost of production before royalty during the quarter was $997, improving from $1,034 in the previous quarter, primarily due to higher metal volume, operational efficiency, and lower diesel costs, partly offset by higher mine development expenses. COP also improved from a year ago by 3%, from $1,022 to $997, primarily due to higher acid credits. For the year-to-date period, COP increased by 3% to 1025, primarily on account of higher mine development, steep increase in commodity prices, especially coal and diesel, and long-term wage settlement with our labor unions, partly offset by higher acid credits. COP in rupees was further hurt by rupee depreciation. Against our linkage entitlement of over 40%, we continue to get in single digit only, about 3% during the current quarter, due to lower allocation to CPPs and due to evacuation issues. Due to higher revenue and lower COP, EBITDA for the quarter improved by 23% sequentially to rupees 2850 crore. The above revenue and COP resulted in lower EBITDA in Q3 and YTD compared to a year ago by 9% and 13% respectively. Net profit for the quarter was rupees 2197 crore, up 21% sequentially and down 1% YOY, and YTD net profit was down by 11% YOY to rupees 5930 crore. Net profit for both the quarter and the year to date were helped by higher treasury income on account of mark-to-market gains resulting from a decline in general interest rates. Depreciation and amortization, on the other hand, has trended up due to higher capitalization and increased underground ore production, resulting in higher amortization. Our gross investments were at rupees 17,462 crore at the end of the quarter, while net investments were rupees 12,528 crore due to temporary borrowings to pay dividends in November. On the outlook side, project capex is expected to be about $350 million, lower than what we guided earlier. In accordance with the guidance given last quarter, we expect COP to reduce in the second half of the year in the range of 950 to 975. This is on the back of increasing volumes and shaft commissioning and lower coal prices. This implies further reduction of COP in Q4. I will now request Mr. Duggal to sum up today's discussion.
So thank you, Amitabh. And now to sum up, we are delighted to see our total MIC increase during the quarter as compared to a year ago, despite not having any production from open cast. In fact, even for 9 months, we have been able to overcome the vacuum caused by planned closure of open cast operations. Outlook for zinc continues to remain robust on the back of low inventory levels and continued refined metal deficit. We expect further improvement in volume and COP in Q4 on the back of continued ramp-up of mines. We are also on track to reach design MIC capacity of 1.2 MTPA next year as we continue to explore new areas within our brownfield where we get the extension of our ore bodies across our mines and at depth with the better grades. Now with this, I open the floor for questions.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Sumangal Nevetia from Macquarie. Please go ahead.
Yeah, good afternoon, sir. Thanks for the opportunity. My first question is with respect to various projects. Now, the commentary suggests that there are delays in 3 or 4 areas. SK shaft commissioning is delayed to 4th quarter. RA shaft is delayed to 2Q FY20 from 4Q19 earlier. And also the Fuma project at Chanderia is delayed by a quarter. Is it possible to share some details as to what are the issues and the reason behind the delay?
No, I would go mine by mine and would let you know what is the status of the project. So while we have said that there has been improvement in the mine development in the various mines, so you can see that a lot of projects also we have delivered in time. Like you see the SK mill commissioning happened. It was a dream project commissioning in Q3 where, the stabilization of the mill took place and the kind of grade and the recoveries we got from the mill. It was a benchmark, I would say. Then another project in Zawar is the mill commissioning is taking place where we had the ore inventories and which will get treated as the mill will start. There is hardly any delay, I would say, which has happened in SK mine shaft because you see we have already commissioned both the crushers. We have commissioned the shaft as such. The waste is being hauled from the shaft. There is one ore pass which has to connect the various levels of dropping the ore from a higher level to the lower level, which is getting completed. But the effective utilization of the shaft is taking place at SK. And I would say practically there is no delay as such. But with the ore hauling will also take place in this quarter in about a month's time or so. This is the last tick we are doing at SK. As far as the shaft commissioning at Agucha is concerned, we have been, because of the ore body structure and all that, so development issues, there were certain development issues which we have been talking in the previous quarter, and we also said that we will be commissioning the mid shaft. So we commissioned the mid shaft about 2 quarters back, and we started hauling through that shaft. So effective utilization of the shaft also has taken place in that. And there were some financial issues of, the shaft sinker, the party from South Africa. And because of that, there were certain issues. Now we have taken resolved the issue, and now the development at the bottom is on track. But I would not say the effective utilization of the shaft has not taken place. Of course, the ore hauling will take place after the shaft will get commissioned. As far as the Fumer project is concerned, the Fumer project was to get commissioned last quarter. There are some slippages which have happened. One fatality had taken place, you remember, about a couple of quarters back. And we are very, very conscious about whenever this kind of incident happens. And there was certain slowdown because of that. But now we are on track to commission Fumer projects also in the Q4, which will deliver the additional silver and lead production in the next year. If you want some detail about the other project, I can give you that how the projects in the other locations are running. Like RD Mill, I said that we are upgrading the shaft to increase the hauling capacity. We have stripped the passage to accommodate the higher size of the machines. So all actions we are taking to debottleneck the mine to 2 million ton.
Understand. Okay, so next question, in terms of variable cost, only the commodity cost, what are the expected cost reduction in 4Q versus 3Q? Diesel, is it entirely reflected in 3Q?
There is some impact of diesel in Q3, but I think the full impact will be felt in Q4.
But there is a fuel impact also as the new parcels we booked, the coal, these were at $9,500 CIF also. Now, currently the landed cost, the current usage of the coal is at $85. As the stock is getting depleted by new parcels which are getting booked, like, we have booked the parcel at $75 for Q1 next year. So as the time is progressing, the cost of the fuel is coming down. The another good news is that this month there is a good flow of linkage coal, the landed cost of which is also less than $75. So the fuel basket will also give us some advantage. And then as we will progress further, the volume will give us advantage. And then the volume and the hauling cost will also give us some advantage. There are some initiatives which we are taking, like the copper mat which we used to sell. We are in the process of setting up a ancillary unit where it will convert the copper mat into copper sulfate. We eventually will not be purchasing any copper sulfate from the market, which is used in our concentrated plant for recovery.
Right, understand. So just one last question. When we reach 1.2 million tons mine metal production, whichever year, FY21, 22, what will be the mix of zinc and lead? Versus say FY18, I recall it was around 17.5% zinc of the total mine metal production. So what would be that when we reach 1.2?
So it is rising from 17, 18. As we are steadily progressing, it will go to 24%.
Got it. Thank you, sir, and all the best.
As the lead will rise, the silver will also rise in proportion. Apart from that, as we have been telling, some silver will also come from Fumer.
So all that put together, 24-25% is what we are looking at.
Yeah, that's right. Yeah, that's right.
In a year or two.
Yeah. Got it. Thank you.
Thank you. The next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Thanks for taking my question, sir. I have the first question is on cost of production. So while you have guided for H2 FY19 to be between 950 to 975, however in Q3 the cost of production was at $997. So I mean, mathematically coming to 950 to 975 would require at least $50 to $75 reduction from the current level. And on hauling cost and haulage cost and everything, we don't see quite a bit of respite, at least in Q4. So what are the specific things that you are doing so that the guidance is met in H2?
So your maths is absolutely correct. We will probably have to go to 950 or even better. And our confidence in attaining these numbers arises partly from what we know how the volumes are moving up. Then we have the benefit of HSD, coal, and now linkage has started to kick in a significant manner in the month of January as well. So these things will help. Then there are some other initiatives that we are taking, like a huge drive on removal of getting rid of NPAs and scrap residues, etc. So all these things stack up, and we believe that we will be fairly close to 950, maybe lower.
Of course, apart from the operational efficiencies, coke prices are also falling a bit. Linkage may rise from 3%, which was last quarter, to at least 15 to 20%, I would say.
Okay. The second question is regarding what was the grade of material this time, zinc and lead, in this quarter?
The total metal grade was 8.2% in the quarter from the mines.
Okay. And what was it last quarter and year before that?
Year ago it was 8.01. So this quarter is marginally better.
Sure. Okay, helps. Thanks, sir. Thanks.
Welcome.
Thank you. The next question is from the line of Indrajit Agarwal from Goldman Sachs. Please go ahead.
Hello, sir. Thank you for the opportunity. Two questions on my side. One, what could be the reason for lowering your capex guidance from earlier?
So as we have looked at all our expenses and our capex outflows, we did some quick maths. There was one project which we were planning to launch very soon, which has gotten a little deferred. So when we do a complete relook at all our things, we feel that we will be closer to 350 than to the earlier guidance that we had set 400 plus.
And some delay, which in the first question also was explained, that some delay in the shaft commissioning, some capex will also get postponed because of that.
So this also changes your internal production expectation over the next couple of years, or that remains intact?
Unchanged. No, there is hardly any impact which is going to be there, because it is hardly by a quarter or so which is happening. So it does not change the production guidance, because luckily we had ramped up all our mines to the desired level even without commissioning of the shaft. Like you see, the 5 million ton plus run rate ore production we were able to achieve from SK mine, and now the current quarter we are expecting better, even though the shaft has not been commissioned. So similarly in Rampura Bucha, against the original capacity of 3.75 million ton, we produce at a run rate of 3.19 million ton. So this, with this, of course, there could be a further opportunity of the better hauling with the shafts, and reducing the hauling distance and controlling the hauling cost. But I don't think there will be much of an impact on, as far as the ramp up of our production is concerned to 1.2 million ton. Capex is only a timing issue.
Sure, that helps. And second question on other income, we saw a sharp jump this quarter. Any particular reason, or how should we look at it going forward?
So that's mark-to-market gains that have happened on treasury income. The interest rates have become very benign and they have softened this quarter. So we've had a bumper treasury quarter.
All right. Thanks. That's all from my side.
Well.
Thank you. The next question is from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Yeah, thank you very much, sir. So my first question is, if we look at the production profile this year, we had a situation where the first half mine metal production had fallen very sharply, and we understand there was a transitioning. Now, given that most of the projects are going to get commissioned over the next few months, should we now expect a more normalized mine production profile over FY20? I mean, this what we are seeing 3Q and possibly even 4Q, that becomes a new normal, or can we see first half production fall very sharply versus second half of 19?
No, it doesn't happen now, because it is not feast and famine. It used to happen in the open cast. You must have seen, if you compare the underground production of the last 16 quarters, there will be a curve steeping up every quarter, and there is a steady rise which is going on. So at some point of time going forward in a couple of quarters, it will become more steady. And it is not like famine and feast in a first half or second half. So I think there will be more consistency in our production, and we'll be able to serve the market also more consistently and predictably.
Sure, sir. So which basically means that in this quarter we annualized roughly 1 million tons of production or so. So this kind of becomes the base going forward, right?
Oh, absolutely. Absolutely.
Understood. And sir, my second question is regarding inventory, because what the production guidance effectively implies is a very sharp jump in refined metal sales in this quarter. So are we carrying a material concentrate inventory through this quarter?
Not as such. We don't have much of the inventory as such, except some lead inventory is there, still there in our circuit.
Okay. Okay. And lastly, sir, given that we had, for a short term gone for hedging, and what it on hindsight would have turned out to be a very good price, what is the view now? Because zinc prices have been range bound now for a few months. There is talk about new supply coming through and prices falling lower. So would the company be open to do a rolling hedge going forward, or now it's just hands off?
No, this was one off. We will not go for hedging as such, and we have never done it in the past. And as far as market is concerned, if you really dig the record of what the market had predicted over the last 12 quarters and what actually has happened, as far as, the mine metal production is concerned, I was doing my own research, which says that any growth in the mine metal in the last 6 to 7 years has been muted. And that is why the concentrate, the supply has become deficit today, and that is why the stocks have, getting depleted quarter of quarter. So I was also reading the Wood Mackenzie report that there could be, why there could not be a chance of the LME again bouncing back to the highs of 2018.
Understood. Thank you very much, sir.
Thank you. The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. So my first question is on production guidance. I think in the press release we have said that we'll be slightly short of last year's production. This is for refined zinc and lead. Sir, one is how should one look at it for this year? You might not quantify, but some color over here will be useful. Secondly, sir, any thoughts on next year's guidance if you can help specifically with shafts coming in?
So I would say, as far as the guidance is concerned, we have already specified in the guidance that we could be slightly higher than the MIC production last year. But you also know that the refined metal production is a consequence of what we actually produce in the mine. So that is why we have given that guidance. Of course, the lead and silver will be, quite higher than last year. As far as next year is concerned, I would not give a exact guidance to you at this point of time because we are on a drawing board preparing ourselves and looking at the sequence of the stopes. But definitely as the fundamental becomes strong, you see, I would like to explain there are two very strong fundamental apart from the shaft, which I want to explain here, that the filling capacity in the mine is very, very important. So as the mines were ramping up, we had one paste fill plant, each at Rampura Gucha and Chandeswar Khurd. The second paste fill plant is getting commissioned this quarter itself. So one paste fill plant will get commissioned somewhere in early February in our Rampura Gucha mine. And the second paste fill plant at Chandeswar Khurd also will get commissioned somewhere in the first week of March. So this sets up for filling up the mine at a faster sequence. As we fill the primary stopes, the secondary stopes come in sequence. So as we were mining up, the falling of the sequence of the stope which can come into production was coming up. So with this capacity coming up, it gives us a huge opportunity of how quickly we can mine our stopes and how quickly we can turn around. So this is one thing which will set us up. The another is the shafts which will liberate us. The third is that the ventilation issues have been resolved in most of our mines for lifetime. There are a couple of ventilation still raises going on in Zawar, but mostly 80%, 90% it has been resolved. And apart from that, just for the information of everyone, we are also setting up the filling plants at Zawar for the first time in the history. In Zawar, we always used to leave the pillars, and because of which the recovery from the mine used to be very low. At the upper level, there are the pillars which are left out. If we fill the mine, we have the opportunity of mining from the higher level. So all these setting up of the paste fill plant at all our locations will give us the opportunity of mining at a faster sequence. And similarly, at RD mine also, we are setting up another filling plant so that the turnaround of the stopes could be higher. And as we are expanding the mine, the requirement of the filling also becomes higher. So it sets up a strong foundation for the next year. But what exactly number will be coming and what guidance we will give, we will come back to you at the end of the next quarter when we will have the next investor call.
Okay, sir, just to, thanks for the detailed commentary. Sir, so specifically for this quarter, in the prior question you indicated that we have some lead inventory. Sir, then what was the reason why basically we are saying that the volumes for this fiscal will be a bit low? Was it purely on the quality of grade or was it something else?
No, I mean, lead inventory we have in this quarter. Now the opportunity of converting that lead inventory is there, but how much of window is available in the smelting in the current context, we also have to see. But broadly, the FG production is a consequence of MIC production.
Okay, fair enough. Sir, my second question is any specific update on SK North, SK South?
So I would not give you much of a detail on that, but broadly in one sentence I would say that we are becoming legally better off and we could get some positive surprise in the coming quarters. But it could be a fortune changer for Hindustan Zinc.
Okay. Okay. And sir, last question on capital allocation. I think in the earlier call, it was asked specifically on the urea plant fertilizer facility. Sir, any plans that we have formed up right now? I think in the prior question you indicated of sulfuric acid something. Sir, anything over here?
Yeah, the project is on. We have also inducted, very senior advisor who is trying to add a lot of value in terms of, bringing a better technology and bringing, the know-how where we can produce the DAP with the nutrients and with a little bit of the tweaking of the technology and maybe, building up a capacity which could bring a better economics in terms of, better IRR. So we have again gone back to the drawing board. We will come back to you when this exercise will be completed.
Okay, sir, any possibility of giving an indication on timeline or capex that the specific project will entail?
So if the exercise is completed within this quarter, which will also bring a better robustness into the project and the better sense and better IRR, we may take this proposal to the board next quarter.
Okay, perfect. That helps. Thank you so much, sir.
Thank you. The next question is from the line of Sanjay Jain from Motilal Oswal Securities. Please go ahead.
Thanks for taking my question. This is regarding our capacity. I mean, you talked about that in FY20 will be 1.2 million ton. And you still, there are some projects which still will get completed in the end of first half FY20. So my question is, when would you say that we are now 1.2 million ton production? We are capable of producing 1.2 million ton metal MIC. Will it be the end of FY20 or it will be end of first half FY20?
No, I think at the end of this quarter, that means the quarter 4 or onset of the new financial year, we will be almost there at a design capacity of 1.2 million ton, but there could be some minor event which I said that maybe shaft will get commissioned and where we can, when we can finally say that we are at a capacity of 1.2 million ton at that point of time.
But would you need this shafts, all this SK mine shaft and Rampura Gucha mine shaft to be fully operational for 1.2, or they are not necessarily needed for it because you have a lot of declines?
No, we have a lot of declines, but you also have to appreciate as we are going down, the hauling distances are becoming better. The importance of the shaft also becomes more and more as we go deeper. So I think with SK shaft getting commissioned this quarter, the challenge will be over. And in Rampura Gucha, although we have been able to debottleneck through the mid shaft and the declines, and one of the decline we have opened in the open pit also, so that we can have the two passages through which the material could be hauled. But I think finally the shaft commissioning at Rampura Gucha also makes a lot of sense because it will be able to debottleneck the hauling issues.
Got it. So, what is what kind of utilization one can expect once this 1.2 million ton capacity is achieved? Will it be like 90% or can we go to 100%?
So it is not, mining is not like a surface plant in which we will say that, when we will set up the plant, the capacity utilization where you can say that it is 90%, 95% or something like that. Mining is also outcome of what sequence of stopes and which grade and what size of the ore body is coming in sequence in that particular quarter or that particular year, which will determine whether the capacity utilization could be 100%, it could be slightly more, it could be slightly less, but the overall infrastructure is in place to mine at 100%.
Got it. Thank you so much.
Thank you. We'll be able to take one last question. The last question is from the line of Abhishek Poddar from Kotak Securities. Please go ahead.
Hi. Thanks for taking my question, sir. Just one question on the smelter enhancement of the capacity. So are we already there with 1.2? Is it aligned or what timelines can we look at there?
So we are, the debottlenecking efforts are going on, and we will be at a capacity which is around 1.13 or so next year as the mine capacity will ramp up. in the coming quarters. So ultimately we will be prepared to smelt at a run rate of 1.13, which is the outcome of the MIC production of 1.2 million ton.
Yeah, so this will be by end of FY20 or before that?
No, I think it will be before that.
Okay. So just on this, would we need to sell more concentrate in FY20 because this capacity?
Never.
Okay, we don't have.
Never. We'll never do it.
Okay. Thanks a lot, sir. Thank you.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to Ms. Preeti Dubey for closing comments.
Thank you, everyone. If you have any further questions, please feel free to contact me. Thank you.